ConocoPhillips is acquiring one of the larger independent Texas shale companies for $9.7 billion. So Wood Mackenzie, the well-respected international consultancy, issued a press release and said that this was a very, very significant deal. Will position ConocoPhillips just behind ExxonMobil in the U.S. shale industry, and it's a big deal. Well, University of Houston economist Ed Hirst begs to differ. We're going to talk to him about that. Welcome to the interview, Ed.
Well, thank you very much, Markham.
Now, you have a slightly different take, maybe a radically different take than Wood Mackenzie, so let's hear it.
Well, so this transaction's a little over $9 billion, and so, barely 2 years ago, Concho bought RSP Permian for a little over $9 billion in a combination. And so if you think that the shale plays have got some legs and the price environment is going to recover, then it makes sense to see a continued consolidation here. I've been puzzled by the Conoco management, though, over the last several years. They've spent billions pursuing some of these plays, and they've written off billions. They exited the Gulf of Mexico, and later the CEO stood up at the Offshore Technology Conference to say that the Gulf of Mexico is where it needs to be.
Well, look, what I'm really interested in here is your view that the, particularly the Permian Basin, is not a great place to invest. That there, and more than likely, we're going to have a lower for longer oil price environment, which doesn't bode well for shale because it requires a lot of capital. It's fairly high cost, as you say, very often a marginal barrel. So is that what we're getting at here, Ed, that shale is maybe going to decline for a while?
Well, it's going to continue to decline. The shale plays are the expensive plays across the universe of oil plays. And it's not expensive because of seismic. It's expensive because the wells, for the cost of the wells, don't produce nearly as much as a conventional well would. And so you eliminate some geologic risk, but you trade away for that the upside that's necessary and important for you. Keep in mind, Concho is down by more than 60% over its high back in 2018. And so, that was after shale had already recovered from the 2015, 2016 debacle. And so, to a certain extent, Conoco is picking up assets that are cheaply valued. Well, there's a reason they're cheaply valued. They just don't perform as well as the conventional plays. But Conoco made a strategic decision, now 5, 6, 7 years ago, and really cut out its exploration staff. What's left is not nearly the ability that they had to pursue Gulf of Mexico, to pursue conventional plays. This is all they can afford to do right now.
You've made a point in previous interviews with you. You've told me that the those companies that get into a play like the Permian Basin get in early. They get the land cheap, and they might be economic. They might be profitable. And then the Johnny-come-latelys like ConocoPhillips come in and they buy assets. Even if they're discounted and cheap today, they're still expensive. And it's not a great move, and more than likely it'll come back to haunt them. Still of the same view?
Well, yes, but of course at this point, we said earlier, the value of the shales are down tremendously. And so while RSP Permian just 2 years ago was bought for over $9 billion by Concho, now the combined enterprise is being bought for less than the purchase of that acquisition by itself. And we've seen the same thing with, unfortunately, Occidental and Anadarko. That acquisition, goodness, they paid so much money for the Anadarko, and now the combined entity is worth less than, or the equity is worth less than what they paid for Anadarko alone.
So last question, Ed, and I guess this deal is predicated on the view that oil prices will eventually recover and get to a point where they can sustain the shale operations. And there is a school of thought that says that the oil and gas there's been global underinvestment for a number of years, and that would suggest that maybe prices are going to go up. Are you of that view, or is this really, I guess, you have said this is a long-term decline, but what can we expect from your point of view of global oil prices?
Well, from my perspective, we're seeing the rig count down about 25% across the globe. Let's ignore the United States for a minute and ignore the shale plays. So at 93 million barrels a day, just several years ago, we had more than 3,000 rigs turning globally. Right now, it's about 1,250 rigs turning. In the Middle East, the rig count is down by more than a quarter since the beginning of the year. And so this tells us that we're not drilling enough to maintain the replenishment of supply to get us to keep us in a 93 million barrel a day market, and let alone get us back to a pre-pandemic market of 100 million barrels a day. So I'm expecting that in the next 2 years, and potentially immediately after the US election, we'll see oil prices begin to inch up. It depends on how the Saudis and OPEC want to manage this. Globally, it makes a lot of sense to begin to ease prices up a bit for their reinvestment, but not increase the prices so much that it brings the U.S. shale plays back into a position where they can have free and easy, cheap capital.
Ed, thank you very much for this. Always appreciate your insights into global oil deals and prices. So thank you very much. I'm sure we'll be talking to you again in the near future.
My pleasure, Martin.